So you want to buy a car dealership. You drive down the highway and see row after row of shiny new Fords, gleaming Porsche showrooms that look like luxury art galleries, or those exotic Lamborghini dealerships where a single car costs more than most people's houses. You probably wonder, how much money does these places actually make? Are the owners printing cash by selling cars, or is there a lot more to it? Owning a car dealership is one of the most capital-intensive, complex, and potentially rewarding businesses out there. It's not just about selling vehicles. It's a sophisticated operation blending retail, finance, service, real estate, and heavy inventory management. Today, we're diving deep into the economics of owning one, from the massive costs to get in, to where the real profits come from, and the serious threats that can derail even highly experienced owners in this game. Let's start with the entry barrier, because this is where most dreams hit reality fast. If you're thinking about a brand new franchise dealership for a major manufacturer like Ford or Chevrolet, you're looking at an enormous investment. According to industry data from the National Automobile Dealers Association and other sources, the average startup or acquisition cost for a full new car dealership can run around $11 million or more. That includes buying or leasing prime real estate, building or renovating a large facility with showrooms, service bays, and parts departments, plus stocking initial inventory. For luxury brands like Porsche or Lamborghini, the numbers climb even higher because of stricter franchise requirements, higher-end facilities, and the need for specialized service capabilities. You might need $15 to $30 million or beyond depending on location and scale. Why so much? Manufacturers don't just hand out franchises. You need to prove financial strength, experience in the auto business, and often a significant net worth. The franchise agreement ties you to their rules on branding, pricing, customer service standards, and sales targets. Miss those and you risk losing the franchise. On the lower end, an independent used car dealership can start much smaller, maybe $100,000 to $500,000 for a modest lot, licensing, basic inventory of 20 to 50 cars, and a small office. Some scrappy operators bootstrap with even less, around $10,000 to $50,000 in high-volume states, but scaling profitably is tough without more capital. Once you're in, the biggest ongoing cost is inventory. New car dealers rely heavily on floor plan financing, essentially a revolving line of credit from banks or the manufacturer to buy vehicles from the factory. You pay interest on each car from the day it arrives until it sells. If interest rates are high or cars sit too long, those daily holding costs eat into profits fast. A typical new vehicle might cost you $7 to $10 a day or more in floor plan interest, insurance, and depreciation. Turn inventory slowly, and you're in trouble. Used car dealers face similar issues but source from auctions, trade-ins, or wholesalers, often with thinner but more flexible margins. Let's talk sales margins, the most visible part of the business. On new cars, gross profit margins are razor thin, often just 2.5% to 5% on the vehicle itself, sometimes averaging around 3.9%. For a $40,000 Ford, that might mean only $1,000 to $2,000 gross before expenses. Luxury brands like Porsche or Lamborghini can have higher markups, sometimes 8 to 15% on select models, because demand is strong and buyers are less price sensitive. But even then, the new car department frequently loses money or barely breaks even on a net basis after salaries, advertising, and overhead. Dealerships often use new car sales as a loss leader to drive traffic into the higher profit areas. Used cars offer better margins, typically $1,500 to $3,000 gross profit per vehicle, or around 8 to 13% depending on the market and how well you buy. The key is smart purchasing. Buy low at auction or trade, recondition efficiently, and price right. In hot markets, you can flip faster with solid returns. Here's where the real money is made, the back end. F&I finance and insurance is a massive profit center. When a customer finances through the dealership, you earn commissions on the loan, plus big margins on add-ons like extended warranties, gap insurance, tire protection, and paint coatings. These products can deliver $1,500 to $2,500 or more per vehicle in gross profit, often with 50% plus margins. A strong finance and insurance manager can turn a mediocre car deal into a highly profitable one. Many dealerships make more from finance and insurance than from the actual vehicle sale. Even more critical are the fixed operations, service, parts, and body shop. These are the true engines of long-term profitability. According to NADA data and dealership analyses, service and parts can account for 50–60% or more of a dealership's total net profit, even though they represent a smaller slice of total revenue. Labor rates in service bays might run $100 to $200 per hour, with parts marked up 30–50% or higher. A loyal customer base coming back for oil changes, repairs, and recalls generates recurring revenue with much higher margins than car sales. Porsche and Lamborghini dealerships excel here because exotic cars need specialized, expensive maintenance that customers pay premium for. A well-run service department can carry the entire dealership through slow sales periods. Overall dealership net profit margins are surprisingly low, often 1–3% on total revenue after all expenses. A large, successful dealership selling hundreds of cars a month might clear $1 to $5 million in annual net profit, but it depends heavily on volume, location, brand strength, and management. High-volume Ford or Chevy stores in good markets can do very well, while smaller independents scrape by on thinner volumes. Revenue streams of car dealerships include new vehicle sales, used vehicle sales, finance and insurance, service and parts, accessories, detailing, and aftermarket add-ons. Sometimes real estate appreciation if you own the property. Expenses are relentless. Floor plan interest, rent or mortgage on a large lot. Prime auto row locations are expensive. Sales staff commissions, often 20–30% of gross. Technician wages, utilities, marketing, digital ads are costly. Insurance, taxes, software systems for CRM and inventory, and compliance with all the regulations around financing and consumer protection. Inventory turnover is king. Successful dealers aim to turn new cars every 30 to 60 days, and used cars even faster. Slow movers get discounted heavily, hurting margins. Economic factors matter hugely. Interest rates affect customer financing and your floor plan costs. Fuel prices shift demand between trucks and EVs. Supply chain issues or chip shortages can dry up new inventory, and recessions kill discretionary purchases. Risks are significant. Overbuying inventory during a boom can leave you with depreciating assets when the market cools. Manufacturer allocation systems mean you might not get the popular models you need. Labor shortages for skilled technicians hurt service profits. On the upside, a well-run dealership builds massive equity. To succeed, you need sharp management, tight controls on costs, data-driven inventory decisions, strong relationships with lenders and manufacturers, and a customer-first culture that drives service loyalty. Owning a car dealership isn't about selling one car at a time for a quick buck. It's a high-stakes, capital-heavy business where scale, operational excellence, and diversification into service and financing and insurance determine success. The visible car lots are just the storefront. The real economics happen behind the scenes in how efficiently you move metal, finance deals, and keep customers coming back for years. If you have the capital, the patience, and the operational discipline, it can be incredibly rewarding. But it's not for the faint-hearted. Thin margins and big risks mean only the best operators thrive long-term.